Again, everyone, I'm Brian with Fundamental Research Corp, and back with another video. Last time I was on the video, we talked about expected return and risk. So today I want to talk about the second part of that equation, which is risk. How do you manage risk in the stock market, in a stock portfolio, and how do you measure risk? So that's what we're going to talk about today. So risk, a lot of people, if you ask different people, they'll have different opinions on what is risk, but most people think of risk as the chance of losing money, right? So how do we measure that? Traditionally in finance, we measure that as volatility. So the more volatile a stock is, the riskier it is. That's not always in the real life, because if a stock goes down a lot, it could also go up a lot, might continue to go up. But in general, it's measured by volatility. So how do we manage risk in a portfolio? There's two ways really that you can manage risk. One is just know the company you're investing in. Know what you're investing in. As we talked about last time, get in at a good price and stay the course. The second thing is diversification, and you probably heard about this as you've done studies on the stock market. Everyone will tell you diversify. So what does it mean, diversify? The best explanation of a diversification that I've come across is when I was really young and learning about the stock market in a book called A Random Walk Down Wall Street. And the author explained it like this. Let's assume there's an island economy and there's only two industries there. One is a manufacturer of suntan lotions and the other makes umbrellas. So half the year it could rain, half the year it could be sunny, or a little bit of both. So let's say you invested only in the umbrella company and then it was predominantly sunny that year. Well, then you would probably not make a good return on your investment because they would not be selling many umbrellas. Let's say the opposite. You invested all your money in the suntan lotion company and it was raining the whole year. Then same thing, you wouldn't make money. So how do you lessen the risk and not have to bet whether it's going to be predominantly sunny or predominantly raining? Well, you can invest in both, right? So the idea is the losses on one will be offset by the gains on the other, and over a long period of time, you would achieve a return that is smoother. So in practice, how we do this is the portfolios that we build, the assets that we include should not be correlated to each other, right? So that's what's happening in the suntan lotion and the umbrella company example is those assets typically move opposite from each other depending on the weather, right? So you can measure risk by different statistical measures, but let's just, for now, just say a generic measurement of risk, right? So if you have one stock that you invest in, your risk is going to be this high, because if something happens that is negative for this stock, you're probably going to lose money, right? So how do you offset that? You can add a second stock to your portfolio, just like in our island example, and that will lower risk by a lot, right? Assuming that the two stocks are not highly correlated to each other. So maybe the risk comes from here to half. I don't know the exact number, it's just an example, right? So now you add a third stock to the portfolio, which is also not correlated to the other three, and it brings the risk down some more. It won't bring it down as much as adding the first stock, but it will continue to bring the risk down. And as you add more and more stocks to your portfolio, the risk will come down, but less each time. Which means each time you add a stock to the portfolio, the overall risk of the portfolio will come down, but not as much as the previous stock brought it down, right? When you had one stock and you added another one, the risk was cut in half. You add another one, it's cut a little bit more and more and more. But as you add stocks, the risk doesn't drop as fast. So there's a point where adding more and more stocks to the portfolio maybe doesn't reduce risk enough or at all, right? So typically that comes around 20 to 25 stocks. If you hold a portfolio of 20 to 25 stocks, it's going to be pretty well diversified, and adding another stock is not really going to lessen the risk and will actually increase your cost, because now you have to monitor. At a certain point, having to monitor so many stocks will get overwhelming, tedious, right? Managing a portfolio of 20 stocks, keeping track of all the earnings and everything that's impacting each company is not going to be as tedious as if your portfolio had 100 stocks. Okay, so let's review the 3 ways that you can reduce risk in investing. Number 1, know what you're investing in, know it inside out. What does the company do? How do they make money? 2, get in at a good price. What that means is get in at a price that is less than what you value the asset at. If you think something is worth $50, don't pay 51, don't pay 52. Get in less than 50. If it's above what you think it's worth, wait. Number 3, diversify your portfolio. As I said, you want to hold a basket of stocks that don't move in the same direction at the same time, and that should lessen your overall risk in your portfolio. And if you like this video and you learned something today, please go and hit that subscribe button, hit the like button. You can also visit our website, www.researchfrc.com. You can sign up for a membership. You will get alerts as our analysts publish new research on different sectors: mining, cannabis, technology, and also check out our top picks. Over a long period of time, we have outperformed the benchmarks, and you can follow what our analysts believe to be their top picks. It's basically a portfolio of stocks that they have the highest conviction level in, and as I said, historically it's performed very well. So again, thank you for watching, and we'll see you next time.